Now we get to talk about the dark arts of figuring out demand because it is a moving target. You know, they're all estimates at the end of the day. But when we look at the current side, you can see that this past week we had 14.45 million barrels a day of demand for gasoline, jet, disti, and resid. Previous week was 14.66. So again, you still see that we're falling short of that 15 million barrel a day number, which is really important because, again, we should be seeing that marked shift up, and we're just not getting it. And again, it's very much in line with what we've been saying, is that we were going to be better than 21, 22, but worse than 17 through 19. It's just we're going to be in this weird mix because driving demand should be better than 21, but distillate demand is going to be much worse than 21, 22. And then gasoline, as we progress through the summer, we think tracks much closer to kind of a blend of 21, 22. So you're just going to continuously be below where we should be, because when you look at 17 through 19, you normally have that kind of steady move up from, let's call it 15.4 million barrels a day to just over 16, or just right at 16 as you go through the summer. You can see that 19 was a bit of a slower year, and that's why we liken this a little bit closer to where 19 was, and how, you know, we started to get bearish July of 19 because we started to see this breakdown in not only distillate demand, but industrial activity, and that you saw the consumer starting to slow down. Obviously, COVID happened. COVID kind of took the legs out from underneath us, but you then had a massive amount of stimulus come in that really picked up some of that and clouded over the economic distress we were in going into that 2020 period. And now that is coming back, with vengeance. So now when we look at distillate had a build of 2.12 million. Small draw on pad 1. Pad 3 continues to have builds. Now, as we've been saying, pad 3 is going to be the one to watch because we expect exports to slow and imports to be fairly stable. But the export slowdown and the industrial slowdown mixing together is going to put a lot of product in pad 3. Now, getting it from pad 3 to pad 1, the Gulf of Mexico to the East Coast, is the struggle because the Colonial Pipeline is going to be tapped out. They're going to be moving gasoline as much disti as they can, factoring in again the gasoline side. And it's still that Jones Act continues to hinder the amount of product that can move by boat, which we don't see changing any in the near term. So builds, again, fairly normal. It's bifurcated as to where the builds are happening. Pad 1, still 14 million below the 5-year average. We don't see that changing in the near term. We'll go through that in a minute. But pad 3 is where we see the distress point, which is going to be a problem when you start looking at some of those crack spreads. Now, when we start looking at crack spreads, you can see that there's been a little bit of a nice bounce. But the thing is, we see as they ramp up and as those builds continue to compound in pad 3, we see that moving back down closer to the 20 ratio, especially because out here, refiners are going to run as much as they can. They're going to try to increase some of these, not only gasoline, but when you make gasoline, you're going to make distillate. And what are you going to do with that? You know, and when we look at some of the different production levels, just pulling up production here, you know, production was up about 1.7% for gasoline, down a bit for distillate by about 1.4. But as that pivots, you're going to see those increases in general, especially as gasoline comes up, distillate will come up, and we do expect to see some pressure on the crack spread from this point going forward. Pad 1, again, sideways move. We're right where we were in 2022. You know, so it's going to be that have and have not. So at this level, we should see imports, you know, get incentivized. We should see the ARB opening. The question is going to be, where is it coming from? There's obviously that pivot where the Middle East can import Russian product, export more of their product. We have Kuwait that is turning on their refiner, more pieces of their refiner, because remember, it's kind of the rolling startup. And that's changing the game, where it's going to take more medium sour out of the market, but put more product into the market, because for those that have been talking to me for however long, since 2014, I've been saying like there's a big pivot in strategy coming from the Middle East, where why are we continuously exporting the lower value product? Let's build our own petchem or more petchem, more refining, and export the higher value molecule, less of the lower value molecule. And that's where we've seen some of those pivots. But again, that's going to, we need to see that show up in pad 1 at this point in time, as pad 3 has that big shift higher. And this is what we've been talking about. And we've been saying that as we see this competition for Russian distillate coming into the Atlantic Basin, taking some of our market share, more product coming from the Middle East, that was going to push back U.S. product onto our shore. And here's where we're going to see that build. And we do see this continuing to go up. We don't have heating oil demand the same way, obviously because of seasonality. We don't have industrial demand the same way we have over the last couple of years. So again, we do see this building very quickly. Now, when we look at distillate supply, that demand level, here you can see it continues to languish. It's going to be below the 5-year average. We don't think it makes new seasonally adjusted lows, just stays at the very low end of that cloud as we go through the remainder of the summer and into the fall season. FreightWaves is just giving you some ideas on it. June is normally one of the best months of the year in trucking and sets the tone for the rest of the year. Unfortunately, it's not providing much of the relief for struggling carriers. Trucking spot rates are now lower than 2019. And remember, when we were watching 2019, because fortunately I had the opportunity to meet Craig back then, and I've been following his stuff ever since. It's absolutely fantastic. And again, 2019, we're like, wow, like things should be picking up, and they're not. Like, what is this? What is this showing us? And the fact that we're now comparing it to 2019 is a problem because, again, the consumer's slowing. You're seeing inventory builds, which just means that people aren't going to the same activity. And we'll talk more about this in the econ show. And that's putting pressure on the underlying basis, where when you look on a cash flow basis, the story for carriers operating the spot market, things are worse. Operating costs net of fuel are up at least 30 cents a mile since 2019. Almost every mile run in the spot market is for a loss. So, but you still want to keep guys active. So the issue is, like, we still have activity, stuff still has to move. It's just we have a lot of capacity. So this dynamic is showing up in the tender rejections, the percentage of truckloads that trucking companies reject. Right now, we're bouncing on the bottom near all-time lows. Carriers are taking almost any load without regard to rate or destination because they need to keep guys active. And there's only so many times you can run on a loss. Now, contract margins are still higher, but when they mark to market, you're going to get a big move down, and the pressure is going to mount once again. And here's just another look at marketing demand, the Internet Truck Shop Market Demand Index. You can see rolling over a bit, and this is when we should be seeing strength, not this continued softness, which again is just more confirmation of what we're seeing. Now, when we look at U.S. rail traffic, total carloads are up 0.6, but a lot of that is, again, motor vehicles, metallic ores, things that are not going to slow down because there's still that backlog on building cars, getting that inventory back to comfortable levels. Grains have come down. There's a lot of drought issues, which we'll talk more about in next tomorrow. But then when you start looking at intermodal, and the intermodal and the trucking side are close to each other. And here you can see intermodal was down 11.2% again. So total traffic is down 5.9%. And intermodal is again confirming the issues we're seeing on that consumer side. And that's where we see that crux of the issue when we're looking at how demand just isn't going to be all that strong as we come into those peak seasons. Now, when we start looking backwards and look at activity coming on shore, here you can see the average wait time is still low. Vessels within 40-mile nautical mile range still at 0. So you've had some things pull through. There is some support again to keep kind of trucking where it is, and the numbers look really good when you compare them versus last year, the previous year and previous week. But remember, last year there was a little bit of that drop off because we did have the strikes. We had a lot of those issues in terms of what could move into the system. That skewed the numbers a bit. So if you average it out, it's still better than it was, but again, still below what is average at this point in time, confirming again some of those underlying slowdowns. Now, when we look at temperature, East Coast, West Coast are fairly normal, slightly below normal, but again, not too much one way or the other. The center of the country, a lot of heat right now. That's a problem when you consider farming. When you look at the precipitation, 3 states, this is the driest they've been since 1934. And for those that don't know, 1934 is comparing us to the worst year of the Dust Bowl. So again, you're seeing a lot of pressure in terms of demand, in terms of availability for crops, yields. But again, here you'll have some support for natural gas. So we don't see too much up or down, just because you have some coolness on the West Coast, East Coast, which will help keep things fairly kind of flattish when you look at natural gas demand levels. Gasoline stockpiles had a build of 2.11 million, 16.8 million below the 5-year average, but 3.4 million above the 2022. That's something that we think continues to grind higher. You had builds into pad 1 of 2.4 million. You had builds into pad 3 of 1.8. Pad 2 had a nice drop. When you look at finished motor gasoline and blending components had a build of just 620,000. So it just means that you're getting some of that balancing act. That the blending components is going to be one to watch. So we should see a little bit of that pull down. But remember, we have a long weekend coming up ahead of July 4th. So you're starting to see that blending accelerate. But then you look at imports. Imports were up 80,000 barrels a day, up 123,000 into pad 1. So on an aggregate, we were up 283,000 barrels a day more over the 5-year. 323,000 into pad 1 on a 5-year basis, obviously still well above year over year. And that's not something we see changing. And that's the biggest issue in general when we look at underlying flows, because demand is going to increase, but at the same time, you see gasoline prices staying elevated. So, and again, to the consumer, which is going to keep that arbitrage open. So we do see imports remaining elevated. They'll step back a bit just because you can't maintain 957,000 barrels a day into pad 1. But it doesn't mean that you're not going to stay at that elevated level, which is what we were saying. It's that we weren't going to see this massive surge and collapse. It was going to be that 750, 850,000 barrels a day, just very consistently coming into the system. Obviously, you have timing delays, which will get these spikes. But realistically, there's a lot of imports that are still going to target, because when you look at Europe, it's still a record amount or just below a record amount, with 2020 being higher in those totals. Blending components going a bit sideways here. You can see that we're just above 2022 levels. Petchem is just getting decimated. We see a lot of pressure in those crack spreads, which again is going to put more of this product into the gasoline pool, less into the chems pool. And then when you start looking at demand, one of the things that we said is that Asia Pacific is showing some of the cracks sooner on an economic level, where you can see it's marrying 2022. So we're not back to 2019 levels. We're still below that 2019 or that normalcy, and coming in at 2022. And because we see emerging markets, i.e. a lot of parts of Asia, getting a bit worse, we see that actually rolling down. By no means going to 2021 levels, but actually going below 22 levels. When you look at Europe, things are right in line with about 2022. But then you look at North America, you have that seasonal bounce. But as we've been saying, we're going to stay below 2019 levels and just going to go a bit sideways from here, and not going to have this big rollover. We're by no means saying that, which is why we think that gasoline versus 22, 21 will be better on that congestion basis, but still not 2019 levels. Now, according to Gas Buddy data, U.S. gasoline demand fell 2.3% from the prior week and was 4.2% below the 4-week rolling average. According to Gas Buddy data, U.S. gasoline demand continued to struggle this week. Every day this week, Sunday to Tuesday, is down over 2% from the same day last week. and every day also 2% below the 4-week rolling average. So again, that's where we see kind of this slowdown, this sluggishness, and that hasn't been reflected in the EIA data to a point where by the time EIA data drops, this will we expect Gas Buddy and TomTom to show that, okay, we had that long weekend. Now, schools are in the Northeast, parts of the West Coast, the East Coast are ending. That'll put people on the road at a greater level, and again, that's going to be a bigger component. The problem is, even though demand is a bit weaker, again, supply is not huge right now, which is why you still get those elevated gasoline prices, even though prices have come down in crude. Demand really isn't there, and that's going to increase inflation, or at least the pain at the pump, keeping people less active during key driving season. And here's where we're looking at that, and this is for those that have been following us, we said gasoline prices were going to flatline. You have shift to summer blends. You do have more demand in general just because we are in the summer months. And then diesel prices continue to come down. We do see more pressure to the downside on diesel, which should be a positive for trucking. And again, they're already operating at a loss. So diesel prices coming down will just mean that they're going to lose hopefully less money, but they're still going to lose money. So you're not getting that benefit either, because they're going to try to push through as much pricing as they can, keeping our goods a bit elevated in price. But again, gasoline is not going to wane in the near term. Now, when we look at gasoline demand, as we had showed in segment 1, you can see that we're right just above that 10-year average, and we see that flatlining. Like we see a little bit, one more dip. Does it break 9 million barrels a day in that dip on their calculation? No. We're likely now at about between 9.1, and then we'll grind higher. We are going to go up. We will see another 300,000 barrels a day of demand. But again, look at the 10-year rolling average, that 10-year average. We normally have an increase. We are not saying that we're not going to get that. We will get an increase. It's going to be below what is normal because of that pressure on the consumer side, on that pricing side. Propane had a massive build of 3.12 million barrels, bringing us 18.3 million over the 5-year. And when you look at it going back to 2015 as a seasonally adjusted all-time high, we're making a lot of NGLs. We don't have a lot of activity in U.S. petchem. And again, this is keeping prices low. And we just continue to see a massive amount of product, LPG, going into the international market, and we don't see that stopping. When we look at jet fuel, it was, bills were, essentially flat. When you look at the underlying demand cycle, in general, we had demand at 1.54. For those that have been following us, we said 1.45 to 1.55. Now we're past that point, and here you have to kind of pivot. And we expect to be closer to about 1.5, 1.6 at this point. We initially thought we were going to go to 1.55, 1.65. It's been a little bit more sluggish than we were expecting, which is why we're just shifting it down ever so slightly. But again, you could see it's still below average. And that's something that we think is going to be continuous as we go through the remainder of the year for the most part, not even just summer. So 12 weeks ahead, you can see global number of passenger increased 4.9%. Number of passenger flights over the week of June 6th to 12th rose 2.4%. But again, summer. So we typically have a run up, and then you kind of peak in July, August, and then you start to see some of those declines. And then obviously you peak again going into Thanksgiving, Christmas. But this is what we've continued to see. On a passenger basis, one of the things that we've said is that Europe was going to stay 8% below normal, where U.S. was going to stay pretty much in line, and that's what we have here. When you look at delays and cancellations, it's continuing to be a problem. That's not something we see changing, which again will kind of walk back some of those demand numbers. And then when we start looking at TSA passengers, again, ever so slightly below 19, but not too much one way or the other. But remember, 19 got a bit softer, so you're not looking at really peak numbers, but still close enough to peak that, we should be hitting that pretty easily. But then on the open table side, now that we've started to get some of the better numbers get baked in, you can see that we're starting to see that broader softness on eating out. And again, the comps are a bit harder just because, for those that have seen their local restaurants, keep and now start using the outdoor space, now maintaining it. So comps are a bit harder, but here you can see that it's still going to continue to walk back and showing a bit more weakness on the consumer front. So that's what we have for you for the U.S. Again, we're still very cautious on demand. Is it a goose egg? No, we will grow. It's just going to be, I think, well below what expectations are. And that's, again, things that OPEC was seeing, Saudi was seeing, and you continue to see it play out in the economic data that we love so much and talk about which we'll talk about again tomorrow. So in the next segment, we're going to go deeper into OPEC pricing, and where do we see things going from this point in time.